If somebody is a sole proprietor, as opposed to maybe an LLC or an S Corp, if you're paying your kids, do you have to pay anything additional, and do those kids have to pay tax on that money?
For the S Corp, you will be paying payroll taxes on the kids, Social Security and Medicare, and then some states, which you would need to check with your state, you will likely have to pay state unemployment on the children as well.
Guys, I am so excited for you to tune in to this interview, so let's get started. Kelly, welcome to Generation Wealth. Thanks so much for coming on the show.
Thank you. I'm so excited.
Oh my gosh, I'm glad to have you here. When we first met, so just for the audience to kind of know, and for the listeners tuning in, when we first met, I didn't realize the depth of experience that you had in taxes. And after a few conversations, I was like, whoa, this girl nerds out about taxes as much as I do. And so I wanted to bring this on because, as most people know, like, that's a question I get asked all the time. Like, one, how did I learn so much in taxes? And two, can you help me do my taxes? So I love to be able to share good information with people. So can you take us back a little bit? Obviously, I know you're a CPA, but you're involved in so many other aspects with what you do. And what I love what you do is there are so many people that are tax preparers. And I don't know why they're just preparers, but like, you really get into the strategy. And one thing I said to you is, I said, if we work together, do I have to find the loopholes and stuff? And do you remember what you said to me?
I said, if you brought loopholes to me, I would not be doing my job.
That's right. And so I was like, wow, because most of the time, unless you have someone that's really into the strategy and doing the research, because it changes all the time, you can miss out on a lot of things. So can you maybe explain a little bit of the difference of tax strategy versus tax preparation or planning?
Yeah, so to me, the biggest difference in tax preparation is you're looking backwards. So, you know, most people's relationships with their tax preparer, you meet them once a year at tax season. And for the most part, everything is done for the prior year. You can't make adjustments. You can't talk about, things that could get your tax down because the year's closed. Whereas a tax strategist, you're looking proactively at the coming year. So, you may look at the whole year. You may be looking at the last quarter, but it's quarterly. You're just allowing yourself to look proactively at what we can do to get those taxes down or meet your goals, no matter what they are, short-term or long-term.
Yeah, and you primarily work with entrepreneurs, right?
Absolutely.
And so obviously the listener base here is mostly entrepreneurs. Can you share a few things when maybe you brought on a new client, maybe they've been in business 10 years, and they've been filing their taxes, and you start working with them and you're like, oh my gosh, you've left this or this on the table. Can you speak to maybe a few common things that entrepreneurs miss?
Yeah, absolutely. So the first thing that I always like to do is just take a look at the last couple of years. And for someone that's got like the experience in this strategy, there are things that jump out really quickly. A lot of it is just pretty basic as far as deductions that they may not have taken that are kind of related to their industry maybe. You know, you have little things like a home office or cell phone, internet, things like that, especially after COVID. So many more people are working from home, that those things that you were paying already personally now have a business purpose, and those are super easy to overlook. Or, subscriptions through your Apple account or whatever, just those $2.99 a month. While that seems so small, you add them up, and they can really add up when you look at all of the things that you could be missing. Those are kind of small potatoes, but another thing would be, does that individual have children? Are the kids already helping in the job? You know, maybe they're shredding papers or, they're cleaning up at night, things like that. And if so, could we get them on payroll? Would there be a benefit there? So essentially you're paying your kids, and then you could take it one step further, put it into a Roth, and you've got essentially their future, their education in the future now deducted on a tax return.
Yeah.
So those are a couple things that are really fun to find and like have those conversations, because for the most part, people are already paying it, and now you get to deduct it.
Yeah. And it's interesting because that one piece that you just talked about, I went viral sharing that tactic, which I guess most people aren't aware, but that's also because more and more people are aware of it. There's also a few ways that you can do that wrong.
Right. Absolutely.
So can you just maybe share some of the whoa, don't do this, or here's how to do it right?
Right. Yeah, absolutely. So the biggest thing that you want to take into account is that the job that the kids are doing is reasonable based off their age, and that the the pay rate is reasonable based off their work. So, you really want to kind of compare what would you pay someone else to do that. I mean, if they're shredding papers here and there, they're at the office maybe once a month, you don't want to be paying them necessarily $13,000 a year for that kind of work. So it really needs to be reasonable for the work ethic or the work product and their age. And then also making sure that you have it documented. Just because they're kids, that doesn't mean, and they're your kids, doesn't mean that you can't follow the procedures that need to be done. So making sure that there's kind of an employment agreement, that depending on how your entity is structured, whether it's a sole proprietorship or maybe an S corp, that you're running the payroll the correct way. So if you do it as a sole proprietorship, you run it one way where you're not having to worry about payroll taxes. Compared to an S corporation, you probably do have to pay the payroll taxes on that for the kids. So those are a couple of ways that you can really kind of get yourself into hot water if you're not documenting things correctly, because at the end of the day, it's still, IRS regulations that we have to follow for the deductions.
Yeah. And so let's unpack that, because this is the one, oftentimes people don't know what, if I share something online,
right.
I have all these people come in, no, you can't do that. You have to pay taxes. This isn't even workout. Right. So let's break that down for everyone to hear.
Yeah.
What is if somebody is a sole proprietor,
right.
as opposed to maybe an LLC or an S corp, if you're paying your kids, do you have to pay anything additional, and do those kids have to pay tax on that money?
Right. So great question. And yeah, absolutely. So the sole proprietorship, that's which a lot of small businesses, especially in the early years, that's what they're doing. And for that, you do not have to pay Social Security, Medicare, so which that's the main portion of payroll taxes. You do not have to pay that for your children. Compared to an LLC or an S corp, an LLC, it's going to depend on if it's a disregarded entity or if it is an S corp. LLC tax is an S corp. But for the S corp, you will be paying payroll taxes on the kids, Social Security and Medicare. And then some states, which you would need to check with your state, you will likely have to pay state unemployment on the children as well. So you really need to make sure that you're also looking at both federal and state guidance on that.
And do you find that overall it's still, when it's a valid deduction and kids are working in the business and they are following all the rules, that it still helps parents reduce their taxable income even when they have to pay a little bit of tax on it,
right.
as opposed to taking the standard deduction for kids?
Yeah, absolutely. And so and so when you have the kids on payroll, whether it be the sole proprietor or the S corp, like you mentioned, the pass-through income, so the kids get a W-2, they do have to file a tax return, but if you keep it less than that threshold for the standard deduction for the kids, the taxable portion, so it changes each year, but about $13,000 is where we're at right now, then you really don't have any additional tax. So you wouldn't have any income tax at the child's level. You would just have the payroll taxes that you may have had to pay depending on that. But so there's no additional tax unless you went over that standard for the child.
For the year, which
right,
you're allowed
exactly.
to give them. Yeah.
And then to your question, there's definitely overall a benefit for those that are using their children in their workplace, because you're getting that tax deduction. Then you've got the kids' payroll while it's not being taxed at the income. It's under the threshold, the taxable threshold on the child. So overall, you've got a deduction and you're not paying any additional tax.
And this is just like one of many,
right?
Absolutely.
I
mean, I've seen so many helping entrepreneurs that they don't even like Section 179 and some of these things that are just common, normal business expenses that they're not taking the deduction on.
Right.
And this is just one, like, I don't know why it's such like a hot tip button that people love, but it's like that one thing that everyone's like, oh my gosh, I didn't know this, but this is really one of so many.
Yeah. I think it's people are starting to realize, or maybe it's the I don't know that it's starting to, but they are realizing how expensive children are, and kids are. The older they get, the more they cost. They're in sports, things like that. And so it allows you to have just a tiny bit of that deducted now, if they are doing that work.
Yeah, and then it's taking it one step further too, right? Like I often see parents just handing out and shelling out money all the time, but if you put them on payroll legitimately and you start to teach them how to spend money, how to save money, how to invest money, and you use that money instead of just going and paying for their clothes or their baseball camp or whatever, and you have them take it out of that money that you paid them, you're teaching them something far beyond you getting a tax deduction.
Yeah,
right.
Absolutely.
Like this is going to pay dividends in their life because now they're going to
Right.
understand budgeting and the value of a dollar.
Absolutely. And having the conversations in the household. Historically, conversations about money in houses just weren't done.
Yeah.
And so it also allows, the kids to start that realization. For so long, people, kids, you see your parents swipe a debit card and it's like magic money.
Right.
And so now being able to kind of understand where the money comes from and how it goes. Absolutely.
Right. So they're not in college swiping that magic card.
Exactly.
And being like, why does this work anymore?
I get credit cards. They're free. What do
I
you
know,
mean?
right? Oh my gosh. And that's legit. So I think it really does start at the home. Let's start a little bit about, because people love to talk about what to take and all these fun things. But let's be real. Some of these things, if you do too many of them, the fancy DIF system that the IRS uses can throw some flags and could possibly trigger an audit. So what are some of the things that maybe people can, when they're wanting to take all of these things and they want to do it maybe all of a sudden because they just started listening to this podcast, maybe ways that they can prevent an audit or a potential issue down the road?
Yeah, absolutely. So what's really important, there's the saying that, pigs get fat and hogs get slaughtered. Like you do want to be reasonable about what your deductions are. And there are a couple of different ways that you can do that also. There's always the opportunity for amended returns where you can actually go back a couple of years. For the most part, tax returns are open for 3 years. So depending on when you filed and the deadlines, you have 3 years at a time that are open. But to the question, things like Section 179 as an example, or bonus depreciation. Right now we have bonus depreciation for the next couple of years as well. Some of those things are actually automatic. Bonus depreciation, as an example, is automatic. And so those things are not necessarily a trigger just because it's already a given per se. What you really want to also look at is the type of entity you are. So like a sole proprietorship, if you have a loss for 3 years, 3 years out of a 5-year period specifically, then the IRS can actually come in and say, you know what, that looks like it's actually a hobby. Maybe you're just trying to write off your, makeup sales or clothing sales or photography and to write off your cameras. So it really, no matter what entity type, you really need to make sure that you do have a true business purpose behind everything. And then the other thing would be that your expenses are reasonable for your industry. So on every tax return, no matter how you're taxed as a sole proprietor or an S corp or anything like that, partnership, there's an NAICS code, which is basically the industry code that the IRS says, hey, this is a construction company or this is a professional corporation or a professional company. And that allows the IRS to see how these expense categories compare to the industry standards. So, for example, if you're a realtor and you have office supplies that is like $12,000, and compared to a construction company where office supplies may be $20,000 or $200,000 depending on the size. It's all going to be based off of your revenue, the percentages, and then the industry standards. So making sure that you're not taking expenses that are not reasonable and necessary for your industry. That's kind of a trigger one there. The other thing that's an audit risk is if you're an S corporation and you're not paying yourself a reasonable wage as an owner. That's a big thing right now. And essentially in summary, it's the IRS wants to make sure that you're paying yourself a wage for the work that you're doing instead of just taking everything out as distributions and not paying any payroll taxes. So there's a couple of those like key trigger areas, and every year the IRS actually releases, they call it the Dirty Dozen. And so it's like those areas that are more risky, and it's also just important to have those conversations with your tax preparer, tax strategist. But other than that, if you have legitimate expenses that you've incurred and you want to take bonus depreciation and you want to look at the Augusta rule, I know you talk about that. You want to add the kids. There's nothing wrong with having all of those added in a single year as long as they're legitimate and reasonable.
Yeah.
And so like another one I know that you've talked about before is like a cost segregation study. So that's one thing I'd like to just mention is depreciation is kind of has like its own rules when it comes to that as well. And especially so many people in real estate, depreciation has kind of an even more factor when it comes to lending and things like that. So
So take us through that just a little bit, because I don't want to gloss over the fact, because I do think we have a lot of real estate investors that listen. So take us through a little bit of what you just said. Break that down.
Right. Yeah. So depreciation, in summary, just for everybody to be on the same page, depreciation is essentially a timing deduction, and what it does is it takes the cost of an asset, a larger piece of equipment or furniture or a building, and it essentially takes that deduction and spreads over the useful life of that. And the useful life is determined by the IRS based off of what type it is.
Like commercial buildings have their own useful life. And an HVAC system has one.
Right.
But the beautiful part of it is, like, let's say HVAC, right? You buy that, you take the deduction, you may have bonus depreciation depending on when you're listening to this podcast, and then you get phantom. I always call it like a phantom deduction, because you don't have to pay anything more for that. Like, that's what I love about real estate as opposed to any other asset class. I go and buy a bunch of stocks, and it's like the stock goes up, the stock goes down, and that's what I have to report. But on real estate, I get this phantom deduction that doesn't cost me anything more. Can you break that down for people a bit?
Yeah, absolutely. And so like you said, like a commercial building as an example, so for the most part, that's going to be a 39-year useful life. And so in just kind of the quick summary of it, you take the purchase price of that commercial building, divide it by 39, and you're going to get that amount of a depreciation each year. Now, that's in its simplest form. But if you throw in something like a cost segregation study, which whereas a professional comes in and they break down that cost of the building. So let's just use $500,000 as just a round number. They may say, okay, well, $25,000 of that is actually for electronics. $15,000 is for furniture. So let's just take that quick $40,000. Those two asset classes, electronics or equipment, electronics, and furniture, are actually eligible for bonus depreciation. And so that $40,000 now you could get fully in the year that you purchase it, or 80% in the year that you purchase it, depending on, again, what year you're doing the cost segregation study. And you've got 100% of that $40,000 now that you're able to deduct, in addition to your annual depreciation on the building, the structure itself. And so there's just, if you take that into consideration, you've got, like you said, this phantom depreciation. You didn't pay an additional $40,000.
Yep.
It was part of your purchase price, but now you've got a $40,000 depreciation deduction right away.
Yeah.
And then for lending purposes, lenders, they understand how depreciation works, and they'll add that back for lending. For whenever they're looking at how much you would qualify, they'll add that back to your net income. So it actually looks like you have a higher bottom line, which then is better for lending purposes.
Yeah, and for anyone listening right now that's like, oh my gosh, I'm not going to be able to remember all this. There is no way anyone can.
Yeah.
I mean, this is your full-time thing.
Right.
You've been doing this for almost 20 years.
Right.
And these change all the time.
Absolutely.
So, like, I don't think people realize sometimes, like, how many IRS informational pieces that you get all the time. Do they still fax them, or do they actually email them now?
So we're working on that still. For the most part, we are still faxing to the IRS.
Oh my gosh, that's so crazy.
Yeah.
And they give you, I know in 2020 and 2021 when the tax job tax act, whatever jobs thing went through, like, it was daily. There was new things. Every single day it was something new or some change.
Right.
So how much are you paying attention to all of this, and how much do new things come out?
Yeah, that's a great question. And I mean, the answer is you really have to pay attention to it. Honestly, daily. But we see kind of a trend whenever tax laws get updated. A lot of times it is when we have political changes, and a lot of times, whether their campaign is running on it. So you've got kind of some lead up, what to expect. It makes it fun for tax planning, because you're like, well, if this happens, then this.
Yeah, right.
But if this
Exactly,
happens. But we do see that happen a lot. Like every 4 years. And then also when we have big changes in the economy. economy. So, for instance, when COVID came through, obviously there was a ton of tax changes, whether it be additional funding and then how that was taxed, or credits, both for businesses and individuals. So 2020, I would say, I was providing updates online on social media one day, and I would have to date it. I'd have to say out loud, this is XYD day, because the next day it would have changed already.
Yeah.
And then as CPAs, we do have to have continuing education every year. We have to have ethics every couple of years. So we're also required by our regulatory agencies, and that's just if you're a CPA. A lot of times, especially for tax strategists, they're going to have additional designations, and those regulatory bodies are going to require additional education. The nice thing is we get emails, updates, daily from the IRS and from different magazines and journals. So it's really easy to get the information, but it's also really easy for people to ignore it. And I think that's really why it's important for someone that does care about the strategy, or looking forward instead of just looking backwards. It definitely is a different type of approach.
Yeah, because it surprises me. Like, I didn't realize, because I just had such great situation throughout all of my businesses and companies, that I had a tax strategist.
Right.
So I learned so much. But it's amazing to me how many people don't.
Yeah.
Do you think it's just that they're burnt out? Like, what's the reason that you think that some, even CPAs, well-intended CPAs, just they don't care. Like, they're just trying to get you in, get you out, get your return done. And if you leave $20,000, $30,000, $40,000, $100,000 on the table, that's okay.
Right. Yeah. So in my opinion, our industry, much like other industries, we really are dealing with, kind of a lack of pipeline kind of a thing. And so in that, each CPA, for the most part, has a large clientele. And so unless you take a targeted approach to be strategic and to look forward, it's just really easy to just get the tax returns done, because you're constantly juggling all these clients, and in like deadlines.
An 8-week window, right? Because I know entrepreneurs, we're not the fastest to give you all of our stuff, right? So you're probably not getting stuff till March,
so
and then you have until, so you're doing extensions or whatnot, but it just seems like there's such an influx in a really short period of time. And as you look at the industry, I'm curious what your take is on this.
Yeah.
How do you think it's going to evolve? Like, do you think we have enough people that are like, I want to be an accountant and file taxes in the world? Or are we going to continually have a bottleneck?
Yeah, I think we will continue to have a bottleneck. Even our national CPA society, international societies that have kind of joined together, that's the conversation we're having, is about the pipeline. And in fact, the CPA exam in January of 2024 is adjusting a little bit because of that. So, for instance, with all the changes in technology, one of the sections of the CPA exam, which is 4 parts, one of the sections people can now choose kind of which area they want to focus on. So those that may have been more IT inclined could now be CPAs if they want to focus on the technology part, as well as the numbers, but the technology part. So we're having, as an industry, we're having to kind of adjust things. But yeah, I think, in my opinion, the true tax preparers that are looking backwards are going to kind of be a little bit replaced with technology. I mean, you can take some of the W-2s now, you can take a picture of the QR code and it loads automatically into some of the online softwares and does it for you. So the relationship and that, kind of analytical thinking is really where CPAs are going to have to go, more of the advising, to be able to keep up with trends, to be able to keep up with clients. The relationship is going to matter more and more, in my opinion.
And really, it should be that easy.
Yeah.
Like obviously not for business. When you have property and invest and all of these different things, of course you're going to need someone's assistance. But for just the average person that gets a W-2, you really should not have to pay an additional amount of money to file your taxes.
I agree.
Like it should just be in there. You plug in how many dependents you have, like what your situation is, and it just tells you.
Yeah, because there's nothing you can really change. I mean, if you just get a W-2, it is what it is.
It is what it is, yeah. So let's talk a little bit about, because you mentioned LLC, and S corporation. And I know a lot of listeners, maybe they started with sole proprietor, and then they might have heard something about risk. I talk a lot about like the amount of risk that you have as a sole proprietor, and maybe now they're operating as an LLC. Are there some parameters of when someone, in your opinion, would want to maybe start to think about electing to file as an S corp?
Yeah, absolutely. So, and this, there is no hard and fast rule on this for sure. And if you ask, 10 different preparers, they're going to have different suggestions. And so it's always one of those fun conversations. But the biggest or one of the largest downfalls to a sole proprietorship is there's a form of double taxation. So just to kind of put numbers together, as a sole proprietor, let's say after taxes you make $50,000, or after expenses you make $50,000. Well, that $50,000 is going to be taxed with all of your other household income. Maybe you're married, maybe you have another job, or had retirement, whatever the case. All of that is going to be added together to determine your tax bracket. But that
could potentially take you up, and charge you more tax. Okay,
absolutely. But that $50,000 for the sole proprietorship alone is taxed at 15.3%, which is essentially the Social Security and Medicare tax, in addition to your regular tax bracket. So let's say you're hitting at a 22% bracket. That 15.3 on the 50,000 is then added to your regular tax. So one of the largest downfalls when it comes to sole proprietorship, the more you make, the more taxes you're paying. So what I like to say, and again, like I said, there's no direct line, but if you're going to be consistently making more than like $40,000 to $50,000 after expenses, you're likely to see a benefit in changing over to an LLC tax as an S corp, because you're going to avoid that double taxation on 100% of that net income. Now, yes, you're going to have LLC setup fees. Yes, you're going to have a separate tax return. Yes, you're going to have payroll and the cost of that payroll preparation.
But you're not paying 15.3% on every dollar.
Exactly. Yeah. So it's like in that same example, if you had $50,000 net and you pay yourself a wage of $20,000, you're only paying that 15.3 on the $20,000 instead of the full $50,000.
And that's why the IRS, just to loop all of this together, that's why the IRS is watching what you pay yourself, because they don't want you to have an architect company and now you're all of a sudden pay yourself $20,000
exactly
to only pay the payroll tax on that amount.
Right. That's where the reasonable compensation comes in. Yeah. Absolutely.
Yeah, it's good. It's good. It's important, because I think a lot of times too, I'd love your opinion. It's okay if you don't agree with me. I always say, like, when you start to make that 50, 60,000, that's when you at least have enough stability to pay the additional expenses to maybe think about becoming an S corporation. Do you have a certain amount?
Yeah. So, I mean, I look at more the net income and the consistency of it, and also kind of the goal of the business. I mean, if your goal is growth, then you could take one good year, one good quarter, one good month, especially depending on your industry, to do it. So, I mean, if and like you said, the risk that you're kind of taking away, the liability that you've now got that protection of, all of those other benefits, I am a fan of an LLC S corp just because of all of those things. It also takes some of the audit risk away. Like you don't have to worry so much about those hobby loss rules and things like that.
Yeah, me too. I'm a huge fan when it works for something. Like, to me, if you're starting a business, it's for the purpose of making income. Exactly. So let's just assume that that's everyone's listening's goals.
Right.
If that's the goal and you're already established and you are making some money, it would make sense to consider that. Because if we look at, I always say build to exit. If you look at, like, if you don't want to have a job forever and you want to do something with this, whether it's sell it or gift it or be acquired in any way, you've got to have an entity that lives beyond you. And so you need to be thinking about at least an S corporation, sometimes maybe even a C corporation, depending on what your goals are.
Yeah, exactly. And like the other thing, is what people may not realize is if you start out as a sole proprietor and then later on you want to change to an LLC or an LLC tax as an S corp, that's considered a separate entity. So if you've had an employer identification number that you've been using all these years, now you have to start completely over. And so it's just, you get a fresh start. So you don't have that credit that's tied to the business anymore because it's a new EIN. And so, thinking about what your plans are, your future, short-term, long-term goals in the beginning is very very important because it'll save you down the road potentially as well.
Yeah, it's so good. That's such a good point. And it's always an important thing to remember is what is the goal of the business? What do you want? And then let's reverse engineer everything to that end.
Yeah, absolutely.
You spoke about something that I want to touch on. You said about politics, right? Every 4 or 8, depending on what situation. It doesn't matter who believes what or who likes who or what side of the aisle you're on. That's not what it's about.
Right.
But I think it's important to remember this because I think this is the moment that it became real in everybody's mind that if they weren't a business owner or an investor and they didn't understand a lot of the things that were available to them. I think it was 2016 when former President Trump had first said that somebody was trying to say, you didn't pay any taxes, and he only paid $750 in taxes. And he said, look, he's like, I am taking advantage of the system. I didn't create the system. You created the system, right? Which was kind of funny to hear him actually say that. But I've heard so many people say, how did he do that? Like, how did he make millions, billions in assets? How did you make that amount of money and not pay that tax, like such a low amount? And I know that there's a lot of books and a lot of people talking about tax-free wealth.
Right.
If we just broke him down as an example, because I think what it did was it just brought it to everybody's awareness of, whoa, this is actually possible, where really it was the large corporations that used to do this, right? We've got Facebook that I don't think, do they still pay taxes? They didn't pay taxes for like ever.
Right.
We have these large corporations that the government gives them exclusions for because of lobbyists and dollars in politicians' pockets. But it's also things that we can all take advantage of.
Right.
So if we just break down that like analysis, like pretend that we're Monday morning quarterbacking like the Sunday game, how did he make all of that money and pay $750 in tax?
Yeah, I mean, it all boils down to a strategy. So, knowing what's going to be happening in your businesses in the next couple of years. So if you're not looking kind of short and long term, you're not going to be able to, or it's going to be harder to take advantage of the loopholes and the tax deductions that are out there. So as an example, if you have, like you said, the stock market, things like that are up and down. If this last year, for instance, like with crypto, most people are having losses,
Right.
And so if you're going to have those losses and you're looking to sell something, then you can take advantage of netting those together. There's a couple things that go into that. Is it similar properties or similar type income and stuff? But like that's a great example. It's, tax loss harvesting is kind of what it's called in simplicity. But the things like deductions for the business or for depreciation, that depreciation, Section 179 bonus depreciation, it's a gold mine when it comes to these businesses. The other thing is, if they have copyrights or patents or they have intangible assets, that's another, it's called amortization. It's similar to depreciation, but it's more for those intangible assets. That's kind of another phantom depreciation, essentially, kind of a thing to take into place. There's also a lot of things. So we talk big numbers, but this applies actually to small businesses and even sole proprietors. There's a way that you can fund your retirement where you're getting to deduct those expenses. Well, depending on a retirement plan and depending on how much you're paying yourself, you could put $62,000 into a retirement account. If you do like a solo 401k, you can put even more. So that's an example of, okay, yes, I have a lot of income from my business, but now let's pay my future self retirement, and now I've got that deduction. You've got the deduction there. It's non-taxable because it's a retirement account. Again, kind of depending on the type that you use. And now you've taken that income down to zero. And so it's really looking at, when we look at like something like Trump's tax return, it's looking at every single aspect of it, but also looking at how you can net them against each other. And then there's also looking at the types of income. Is it passive income? Is it active income?
Portfolio income.
Right, exactly.
That's why it's important to have them all.
Yes. Is there, did you buy a hybrid vehicle or install solar panels? All of these credits that are available as well that people don't necessarily think about. So just kind of looking at all of the pieces and putting it together.
Yeah, and I think it's important to touch on what you spoke about because with crypto, because it's
Right.
not just crypto, right?
Right.
It could be real estate, it could be the
absolutely.
stock market, and knowing that you're able to roll those losses over,
Right.
stack them up for when you want to use them, and I think that that's what's really important too with who you work with.
Right.
You have to share what your life goals are, like outside of your return,
Absolutely.
outside of your deduction. Because let's say we're working together, and I'm like, hey, I'm going to buy this massive, $100 million hotel. Well, it's probably not the best to take all of my losses and carry them over into that year and show zero income.
Exactly.
Right? I mean, unless you're a guy like
Absolutely.
Trump and everyone knows you and you have $1 billion under management or so. But I think that that's important for people to understand too. Like if you are looking to, and I just think with a good conscience, we have to share this.
Yeah.
Take all the deductions that are yours to take because you never know if those are going to go away very quickly. 6
Absolutely.
months,
Yeah.
1 year, one political
Right.
cycle. But also make sure that it aligns with what your family and your life
Right.
goals are. If you're looking to buy a bigger home, if you've got a situation with an elderly parent, like you may want to be careful with
Yeah.
when or how much you show one way or the other.
Yeah, absolutely. I mean, that's like one of so I consider tax planning season, kind of the last 3 months of the year. That's when it's really where you're really you've got most of the year down, about what your numbers are going to look like, you can kind of what you were going to expect those last couple of months. And so that's when you can really kind of hone in on what can I take advantage of. So for instance, like going back to the depreciation, because it's a golden one. Maybe you need a new piece of equipment. Now, I'm not saying go out and buy equipment if you don't need it, but maybe you have a construction company, you need an excavator, you need a dozer, you need, whatever it may be. As long as you have possession of that equipment and it's in a business use by that last day of the year, even if you haven't made a single payment, if you're financing it, even if you haven't done anything towards paying that, you can get that deduction because you've got possession of it. It's in the business. It's being used for the business. And so, that's something where you can literally write off $60,000, piece of equipment and not pay your first $1,000 payment on it necessarily.
Yeah.
So, or we look at that same situation. You need a dozer. You need an excavator. This next year, you already have your kind of contracts lined out. Using that same example of a contractor, your year's going to be bigger. Then don't get it this year.
Yeah.
Don't get it in December. Wait until January 1st.
Yeah.
And then you can take that depreciation off this next year's income when you know it's going to be more.
And I think the important through line through all of this is if you are reactively paying taxes and you're not
Right.
intentional about planning them, you're going to leave so much money on the table. And so
Absolutely.
I always say, make sure that at minimum once a quarter that you're meeting with your strategist, your whoever you're
Right.
working with, to be able to say, what did this quarter look like? What's your next projections? So that by the time you roll into October, you kind of have an idea of
Right.
what your burden's going to be. And now you have 2 months to decide before December 31st hits
Right.
what to do. Do I need to roll some income over? Do I need to make sure I what you have that flexibility,
Right.
where you're not doing anything wrong. I think sometimes people
Yeah.
think oh, I'm cheating.
Yeah.
No, these are the laws of the
Right.
government. We're just using them to our advantage because most times, unless you have a full CFO, a controller, or a large business, you don't know that these are available to everyone.
Yeah, absolutely. Absolutely. And that's, what I tell clients is that's not your job to know.
Yes,
that's
that's
my
right.
job. You do what you do and then I come in but that's, like you said, that's why it's important to have those conversations.
Yeah.
Because if I don't know that you're expecting to get, buy a new home or buy a rental property and we need to have higher or lower income, kind of a thing, we need to be more strict on our deductions or that kind of stuff, then I can't, it's again, then you get into that reactive instead of
Right.
proactive.
Can you talk a little bit about, because I know we have all sizes, and I know we have some listeners that have large businesses or those who are scaling
Right.
to get there. Can you speak a little bit about, because I think there's a value to, it's one thing to have one person on your team, but it's another when someone's looking 30,000
Right.
feet in the air down and really seeing your business as a whole, looking at some of your KPIs. Can you speak a little bit about fractional
Yeah.
CFOs and what kind of that role is opposed to having someone that's a CPA,
Right.
the
Yeah.
difference is, and what someone might need a fractional CFO or a CFO in their business, and what the value is there.
Right. Yeah, absolutely. And, and so I'm a big proponent of you do what you do well, I do what I do well. And I think that really plays in to any business, no matter the size. A fractional CFO, what they're going to do, it's there's so many different people that are involved in money in a business, or different names. We have bookkeepers, accountants, you got all these different titles, and it's kind of like, okay, well, what's the difference? But a fractional CFO, what they're really going to do is they're going to take just the basic bookkeeping aspects of it, but they're going to look at it more of the analytical side of things. And that's, I think, the biggest difference between just data entry of a traditional bookkeeper versus a fractional CFO, where they're looking at the business like it's theirs.
Yeah.
They're looking at it, how can we, is our ROI, what's our return on investments, what's our return on assets, those KPIs, like you mentioned, they're looking at those as if they're their own, and being able to take that analytics to management to make those more important decisions. Or we need to be looking at this, our inventory turnover is high or low or whatever. And then, but as far as when to have somebody like that, again, there's no right or wrong answer, but really it's going to be based off how much time that you've got and your knowledge on that.
Yeah.
Again, like as a business owner, depending on how hands-on, so in the startup years, the first few years, or depending on the size, the smaller the business, you're doing all the things for all the
Yep.
people, kind of a thing. And
wearing all the hats.
Exactly. And so if you're not going to be able to look at those numbers in depth like you're really going to want to. And so I would say as soon as you can comfortably pay that position, do it.
Yeah.
Because it's going to pay for itself. Like that's kind of, the whole reason in getting one is you're going to have somebody that's going to bring you more bottom line, or bring you, more deductions,
more clarity,
more
too.
income. Yeah, absolutely.
Yeah, people often think, oh, I can't afford that, but you're already paying for it.
Right.
When you think you can't hire someone, it's forgetting that you're actually already paying someone for it. You're paying yourself for it. And how well are you doing that job? Like if you were actually evaluating yourself on that job, how well are you doing it? And does it bring you joy? So I always say the faster you can hire people, like the who is not you.
Right.
And the more you can hire people to get you out of that so that you can just focus and direct or be in your strength of the business. Right. Because I always say you're the entrepreneur, the manager, the artist. Maybe they're a great artist. And they're the talent in the business. So now they get into this entrepreneurial role, and you're taking yourself out of what you're really, really strong at. So to me, everyone always, when I first came online, I heard like, oh, hire an assistant as your first hire. And I'm like, no. Like, if you're not good at numbers, the one thing that's going to pay for itself in spades is to hire someone that helps you understand taxes and your KPIs in your business. Because if you don't have the bookkeeping in place, you can't take the deductions. You're not going to be able to afford to take the deductions if you don't grow the business. So the KPIs and the data and the numbers is where it's all at. Yeah,
absolutely. I mean, I would say like one of the things that I see is kind of it's scary. It's scary to see, but it's I think the reality, and I think it's important to say, is I would say one of the biggest things that I see as a CPA with new clients or new businesses is they don't have anything set up. So like you can't determine where you need to save money, or even like what your deductions and your income are, if you don't have any kind of system.
Yes.
So, like starting, I tell people don't have to recreate the wheel. If you're good with pen and paper and you have a small enough business to do it on pen and paper, that's fine. Excel, whatever. They have a million different bookkeeping programs that are out there, but if you're not tracking it, you have nowhere to base it off of, or, have no baseline, and you can't even begin to look at those decisions. You're literally leaving money on the table in those situations.
And it's easy to do. Like, so anyone listening and you feel guilt or shame, like, number one, that's not going to serve you. You got to drop that. We've all been there. Like, my just uniqueness was I love numbers and data, so I really would dive into that. That's not most entrepreneurs. Most entrepreneurs are creatives, or they or doing something for a job and then they're doing it for themselves, and that's fine too. But you gotta hire if you ever want to scale your business. Like the number one, there's only two things: people and processes. And the first person that you can hire that's almost like a business partner that can look at your business and say, "Here, we can cut here, we can save money here." Like that's going to pay for itself.
Absolutely. So, and it's like if you can't find somebody that you can pay for a full-time position, outsource a bookkeeper for quarterly or monthly, like whatever you can do. It's
really not that expensive.
Exactly.
Yeah. what it frees up.
Right.
Because you're either doing income producing activity or non-income producing activity. And the more as an owner or a founder that you can continually hire out and you can do whatever you can do income producing to grow the business, grow your sales, focus on sales and marketing, that non-income producing activity that your CFO, your accountant, your bookkeeper is handling all of that.
Right.
That is how you're going to exponentially see results more quickly.
Absolutely.
So tell everyone a little bit about, I obviously know you've been doing this for a really long time. You have your own firm. There's a bunch of things going on also.
Yeah.
So how can people find you, get more information, learn about you? Where are you all on the online space?
Yeah, so I am on Instagram, Facebook, TikTok, all the things. It's at Kelly Ward CPA. So I made it easy because it's across the board. It's those things. And then I've got some courses and things like that on kellywardcpa.com.
Love all of the things. It's so great to be able to nerd out with someone that understands taxes and just have a glass of wine and just talk about all this stuff that's going on. So I appreciate you, and I think it's so important that just business owners find you, find out more of what you're doing, and get this and outsource this so that they're not doing it themselves and leaving money on the table. So thanks so much for being here. I appreciate it.
Thank you.